Well, it didn't take long for mining magnate Gina Rinehart to respond to Fairfax Media's disastrous full-year results, putting a third of her stake in the company up for sale. Fairfax's Financial Review newspaper is reporting tonight that the share block has been pulled off market because of lack of demand, but the message is clear. Fairfax unveiled a loss of nearly $3 billion as the value of its metropolitan newspapers crashed in a world where monetising the digital media revolution is proving extremely difficult. Here's Andrew Robertson.
For months now, Fairfax's biggest shareholder has been scathing in her assessment of the company's financial performance as she's battled Fairfax chairman Roger Corbett for seats on the board. Now she's voting with her feet and selling more shares, but Fairfax boss Greg Hywood is sanguine about Gina Rinehart's thoughts on the company's result.
People can make their own judgments. Shareholders can buy more shares, sell their shares, do whatever they want.
There's no getting round an ugly set of numbers to the point where Fairfax, unlike many other companies, didn't make any attempt to put a positive spin on the result. A net loss of $2.7 billion after writing down the value of its metropolitan newspaper mastheads by $2.8 billion. Revenue was down 6% to $2.3 billion, and even after stripping out the write-downs, pre-tax earnings were down 17%, after-tax profit off 26%. As bad as it was, though, those who follow Fairfax closely say it could have been a lot worse.
Fairfax came out with a generally in-line result with market expectations. The big write-down of goodwill of $2.8 billion was expected by analysts. The big surprise came on the outlook statement, where they suggested that the start to the year had been tough, down around 10%, which is certainly weaker than what the market had expected for their earnings in FY13, has seen the stock sell off almost 10% today.
Greg Hywood went to great lengths to point out that Fairfax's metropolitan newspapers remain profitable, rejecting any suggestions their futures are in doubt.
We've said we are committed to print, right, for as long as print is viable in any mix of formats.
But the future of Fairfax is digital, and the company is banking on next year's introduction of a paywall for its Melbourne Age and Sydney Morning Herald websites to reverse its declining revenues. However, media strategist Steve Allen says it won't happen overnight.
We've got a 3 or 4 year period where we're going to be in this transition, and so profits are going to fall further, unquestionably, during this transition. But we think Fairfax is on the right model.
Wilson Asset Management's Chris Stott shares that view as Fairfax struggles to adjust its business model to its changed circumstances.
We expect that Fairfax will continue to take costs out of their business to try and keep in line with the decline in revenues, but we think that it may become tough for them over the next few years to maintain that run rate. We think that revenues will decline at a faster rate than costs over the short to medium term.
2012 wasn't all bad news for Fairfax. It successfully floated the Trade Me website in New Zealand, where revenue was up 20% and earnings up 13%.